Hey everyone, welcome back to my channel Trading with MT4. In this video, I'll be discussing indicators in MT4 and focusing specifically on moving averages. We will be placing some orders and observing how they behave with the moving average indicator. Additionally, we will discuss the advantages and disadvantages of using the moving average indicator. If you're new here, make sure to hit that subscribe button and turn on notifications so you never miss a video. First off, what are indicators? In MetaTrader 4, indicators are tools that help traders analyze market conditions and make better trading decisions. There are three main types of indicators: trend, oscillator, and volume. Trend indicators are a type of technical analysis tool that traders use to identify the direction of the market trend. These indicators help traders understand the current market conditions and determine whether the market is trending up, down, or sideways. The main goal of trend indicators is to help traders catch the momentum of a trend as early as possible and stay in the trade until the trend shows signs of reversal. This can be particularly useful for swing traders and trend followers who aim to capture large price movements over longer timeframes. Some popular examples of trend indicators include moving averages, Bollinger Bands, and parabolic SAR. Moving averages are particularly popular, as they are simple to understand and can help traders identify support and resistance levels in the market. Bollinger Bands and parabolic SAR are also widely used and can help traders identify potential reversal points in the market. In summary, trend indicators are an important tool for any trader who wants to understand the market and make informed trading decisions. By using these indicators, traders can gain a better understanding of the current trend and increase their chances of success in the market. Oscillator indicators are another type of technical analysis tool that traders use to identify overbought or oversold conditions in the market. These indicators help traders understand the momentum of price movements and determine when a potential trend reversal may occur. Oscillator indicators typically have a range of values that oscillate around a central point, such as a 0 line or a 100 line. When the indicator value moves above or below a certain threshold, it indicates that the market may be overbought or oversold, respectively. Some popular examples of oscillator indicators include the Relative Strength Index, RSI, Stochastic Oscillator, and Commodity Channel Index, CCI. The RSI measures the strength of a security's price action relative to its own past performance, and typically has a range of 0 to 100. The stochastic oscillator measures the position of the current price relative to its price range over a given period of time, and typically has a range of 0 to 100. The CCI measures the difference between the current price and its average price over a given period of time, and typically has a range of -100 to +100. Overall, oscillator indicators are an important tool for any trader who wants to identify potential overbought or oversold conditions in the market. By using these indicators, traders can better understand market momentum and improve their chances of success in the market. Volume indicators are a type of technical analysis tool that traders use to analyze trading volume in the market. These indicators provide insight into the strength of market trends and help traders identify potential price movements. Volume indicators typically measure the amount of trading activity in the market over a given period of time, such as a day, week, or month. They can be displayed as bars or lines, and are often overlaid on top of price charts. Some popular examples of volume indicators include the on-balance volume, OBV, check-in money flow, CMF, and volume weighted average price, VWAP. The OBV measures the buying and selling pressure of a security based on its trading volume, and can be used to confirm trends or identify potential trend reversals. The CMF uses both price and volume data to measure the strength of buying or selling pressure in the market. The VWAP calculates the average price of a security based on its trading volume, and can be used as a benchmark for traders to evaluate their trades. Overall, volume indicators are an important tool for any trader who wants to understand the strength of market trends and identify potential price movements. By using these indicators, traders can gain a better understanding of market activity and make more informed trading decisions. Let us discuss about trending indicator moving average. In future videos, I will discuss other popular indicators in detail. There are several types of moving averages available: simple moving average, exponential moving average, weighted moving average, and smoothed moving average. Simple moving average is the most basic type of moving average, calculated by adding up the closing prices of a security over a certain number of periods and then dividing by the number of periods. Exponential moving average gives more weight to recent price data, making it more responsive to changes in market trends than the simple moving average. It is calculated by giving a greater weight to more recent price data and gradually decreasing the weight of older data. Weighted moving average assigns different weights to each price data point, giving more importance to recent data. This type of moving average is calculated by multiplying each price data point by a weight and then dividing by the sum of the weights. Traders often use a combination of these moving averages in their trading strategies to take advantage of their individual strengths and smooth out any weaknesses. It's important to understand the differences between each type of moving average and choose the one that best suits your trading style and market conditions. In this chart, I have added 50 simple moving average in red, 50 exponential moving average in blue, 50 weighted moving average in purple, and 50 smoothed average in orange. You can see the difference. Even we use the same value 50 for each indicator. In this video, I am going to demonstrate how to develop a simple trading strategy using the simple moving average indicator. I will be using past candles to develop this strategy, so you can see how moving averages can be used to analyze historical price data and make more informed trading decisions. I will walk you through step by step how to create a trading strategy using the SMA, including how to determine entry and exit points, where to place stop-loss orders, and how to manage risk. By the end of this video, you'll have a clear understanding of how to use the SMA to develop a simple but effective trading strategy. Of course, this is just one example of how you can use the SMA in your trading. There are many other ways to use moving averages, and we encourage you to experiment with different timeframes and combinations of moving averages to find the approach that works best for you. So let us get started and learn how to develop a simple trading strategy using the simple moving average indicator. In order to start our analysis, we will begin by selecting a blank chart without any indicators and then choose a 5-minute chart to work with. This will give us a clear view of the price action and allow us to identify potential trading opportunities based on our analysis of the market trends. To detect the market direction, we will be adding a 200 SMA in purple color to our chart. This will allow us to analyze the trend and make more informed trading decisions based on the direction of the market. In addition to the 200 SMA, we will also be adding a 50 SMA in blue color to our chart. This will help us develop a trading strategy based on the analysis of the 200 SMA, as we can use the 50 SMA to identify potential entry and exit points for our trades. Together, these two moving averages will give us a better understanding of the market trends and help us make more informed trading decisions. As the price is below the 200 SMA, it is typically seen as a sign of a downtrend, indicating a bearish sentiment. Now we have to find short entries by further analyzing the 50 SMA with price action. The 50 SMA is a popular tool that helps to smooth out price data by averaging the closing prices of an asset over 50 candles. It can be used to identify trends and potential support and resistance levels in the market. When an asset's price crosses below the 50 SMA, it's seen as a potential bearish signal, indicating that the overall sentiment may be turning negative. On the other hand, if the price hits the 50 SMA and bounces off it, it can also be seen as a potential entry point. This is because the 50-day SMA is often seen as a significant support or resistance level in the market, and a bounce off this level can indicate a potential reversal in the price trend. In the case of this example, we can see that the price of the asset has reversed after reaching the 50 SMA. This suggests that the SMA is acting as a resistance level, and the overall sentiment may be turning bearish. Therefore, based on this analysis, we can take a short position, with the expectation that the price will continue to trend downward. The specific entry point mentioned in the script, 1.10397, would be the price at which the short position is initiated. In this case, we have two options for setting our stop loss. The first option is to use the recent high. By setting our stop loss at this level, we aim to limit our potential losses if the price moves against our position and reaches a higher high. Alternatively, we can set our stop loss at the 200 SMA. By setting our stop loss at this level, we're taking a longer-term view and aiming to limit our potential losses if the price moves against our position and breaks above the 200 SMA, indicating a potential reversal in the trend. When trading in the financial markets, it's essential to have a clear plan for taking profits, just as it is for managing risk. One popular approach is to use a risk-reward ratio of 1 to 2, where the potential profit is twice the amount of potential loss. In this case, the risk is defined as 15 pips, which is the amount that a trader is willing to lose if the trade doesn't go as planned. To achieve a 1 to 2 risk-reward ratio, the potential profit target should be set at twice the amount of the risk, which is 30 pips. Therefore, when initiating this trade, the profit target should be set at 30 pips, which would provide a potential profit that is twice the amount of the potential loss. By using this risk-reward ratio, traders can aim to ensure that their overall profitability remains consistent over time, even if some individual trades result in losses. Let's explore another example to further illustrate our point. In this case, according to 200 SMA, market is in bullish trend. A long position is a trade in which the trader buys an asset, such as a currency, with the expectation that its price will rise. In this case, the price of the asset is currently at 1.10397, and according to the moving average analysis, we can take a long position. In this case, we can consider setting our stop loss at 1.10298, which is the closest low in the chart. We can consider taking profit at 1.10603, which is the higher high in the chart. By taking profit at this level, we aim to realize gains if the price moves in our favor and reaches this level. The risk-reward ratio is more than 1 to 2, indicating that the potential reward of the trade is greater than its potential risk. This is another example of a successful trade, where the trader's potential reward outweighs their potential risk. When trading in the financial markets, it's important to be aware of market conditions and how they can impact the success of trades. One common market condition is a sideways market, where the asset's price remains range-bound and does not exhibit a clear trend. In a sideways market, it can be challenging to identify profitable trading opportunities, as the asset's price tends to oscillate within a relatively narrow range. Additionally, market volatility can be lower in a sideways market, making it more difficult to identify potential entry and exit points. As a result, it's generally advisable to avoid taking trades in a sideways market, as the potential for profit may be limited while the potential for losses remains the same. Instead, traders may consider waiting for the market to exhibit a clear trend before entering trades, as this can provide more reliable signals and potentially higher profit potential. In this example, we were able to achieve a 1-to-1 risk-reward ratio, which means that the potential reward of the trade was equal to its potential risk. While a higher ratio may be more desirable, a 1-to-1 ratio can still be profitable if the trader is consistently able to identify winning trades. It's important to note that a successful trading strategy is not solely based on achieving a high risk-reward ratio. Other factors, such as market analysis, risk management, and consistency in trading, also play a crucial role in achieving profitability. Additionally, traders should be aware of the potential downsides of focusing solely on the risk-reward ratio, such as taking on too much risk in pursuit of a higher reward or missing out on profitable trades that may have a lower ratio but still offer a reasonable potential reward. When it comes to trading strategies, consistency and adherence to a well-defined trade plan are key factors in achieving long-term success. In this strategy, there are many examples of profitable trades that can be identified and executed by following the established rules. By sticking to our trade plan and remaining disciplined in our approach, we can maximize the potential profits of each trade. This may involve carefully analyzing market conditions, identifying clear entry and exit points, and setting appropriate risk management parameters, such as stop-loss orders and take-profit targets. However, it's important to note that no trading strategy is foolproof and there will always be an element of risk involved in any trade. As a result, it's essential to approach trading with a realistic mindset and manage risk effectively to minimize potential losses. In the next video, I am planning to discuss about another popular strategy called moving average crossover. We will be placing some orders and observing how they behave with the moving average crossover. In the meantime, subscribe to our channel, Trading with Nimve, and click the bell icon to stay updated with our latest videos. Until the next video, stay hopeful.